Imagine your portfolio drops 40%. The screens are bleeding red. The news anchors are shouting about billions being wiped out, and everyone around you is screaming to sell before it goes to zero. As a species, we are wired to survive physical threats by sticking together. When early humans saw the rest of the tribe running from a predator, they didn't stop to analyze the data. They ran too. In modern finance, this deeply ingrained survival reflex becomes a liability. When investors see a crowd liquidating their portfolios in a panic, their instinct is to follow the herd instead of evaluating the actual numbers. The brain instantly starts generating terrifying worst-case scenarios. You imagine losing everything, and that sudden flood of anxiety overrides any capacity for logic or long-term planning. As a result, you sell. And the moment you hit that button, a temporary dip becomes a permanent, locked-in loss, all because of a biological reflex designed to keep you from getting eaten. Contrast that reaction with how we behave in a store. If a $1,000 smartphone goes on sale for $600, most people buy it immediately. Yet if a highly profitable company's stock drops from $100 to $60, that exact same person often rushes to sell. This happens because people confuse the current price of an asset with its underlying value. During a market downturn, the price of a stock falls much faster than the actual worth of the business, creating a gap between what the company earns and what the market is paying for it. We seek out discounts in every other area of our lives, yet we retreat from them in the stock market. We can see this cycle clearly by looking at the past. During the 2008 financial crisis, major banks failed, credit froze, and the future of capitalism itself seemed in doubt. Compare that to the spring of 2020. This was a biological shock. Flights grounded, populations locked down, and city streets sat empty. Fear was tangible as the basic functions of global commerce ground to a halt. The catalysts for these two events were completely different, but the human reaction was identical. Panic spread, mass sell-offs followed, and the markets bottomed out. In both cases, the markets eventually recovered and reached new highs. The historical data shows us that while the triggers of a crash constantly change, human psychology repeats itself. The most effective way to bypass this emotional cycle is through mechanical accumulation, specifically a systematic investment plan, where you invest a set amount of money on a fixed schedule. Look at this chart. If you invest a fixed amount of money every month, and the price of a stock is $100, you buy a small number of shares. If the market crashes and the price drops to $50, that exact same monthly investment automatically buys double the shares. As the price line dips into this trough and the rest of the crowd is retreating, your fixed investment is building a much larger ownership stake. During this entire accumulation phase, the companies you are buying haven't stopped functioning. People are still using their software, buying their products, and relying on their services. Only the market sentiment has dropped. Investing through a crash uses the math of ownership to engineer disproportionate future wealth. This chart projects those discounted shares forward over 10 to 20 years. Because you accumulated a large volume of shares at the bottom, your mathematical compounding gets a head start when the market normalizes. This mathematical acceleration only works when buying quality businesses with strong balance sheets and competitive advantages. Purchasing a failing business simply because the price is low remains a dangerous speculation that destroys capital. Elite investors understand this distinction. When headlines suggest impending doom, they remain disciplined, tuning out the noise to focus purely on logic and asset quality. When you look at the mechanics, a market crash functions as a mechanical system for transferring wealth. The next time the market drops 40%, you will have a choice. You can let biology dictate your actions and follow the panic, or you can step away from the crowd and let the chaos work for you.